Hey everyone, welcome back to another video. In this video, I'm going to be talking about a company that I found in the stock market recently that could be trading below intrinsic value per share, and that is Flex. You can see it's also beating the market up about 20% over the last year, while the S&P 500 is down about 15%. So they are beating the market over the last year, and we're going to see in this video if they're presenting a good buying opportunity at the current share price. And so basically, this is Flex's main website, and what Flex does is they mainly just deliver supply chain and manufacturing solutions to different industries and end markets. And we can see right here, these are their financial statements, their balance sheet for September 30th and March 31st, 2022. And during that time period, assets are up from $19.3 billion to about $20.6 billion. The majority of their business is financed by debt compared to equity. We can see it's $16 billion in liabilities and $4 billion in terms of equity. And then right here, this is their income statement. We can see revenue is up year over year from the second quarter fiscal year 2023 of 2021 and then to September 30th, 2022. We can see it's up from $6.2 billion to $7.7 billion. So that's an increase of about 25% year over year in their top line revenues. Gross profit is also up from $465 million to $591 million. But then we can unfortunately see that their net income is down from $336 million to $232 million. So that's a decrease of about 31% year over year. And obviously, if their gross profit is up and their revenue is up, that means that the cost of sales increase was not that big of a deal. It didn't eat into as much of their profits. But if their net income is down, then that means that their operating expenses increased substantially, enough for their net income to decrease in the same time period that their revenues increased. And then lastly, right here, we can see diluted earnings per share are down from about 69 cents per share to 50 cents per share. So that's a decrease of around 28% year over year. So not really a good sign to see that in a period of increasing revenues that their net income decreased. And so we can see right here, this is their cash flow statement on page 9, comparing the first half of their fiscal year 2023 to the first half of their fiscal year 2022. And during that time period, operating cash flow has declined from $514 million to $141 million. And then the repurchases of common shares have totaled to about $253 million in the first half of fiscal year 2023. So that's a good amount of value returned to shareholders, especially considering that operating cash flow only came out to $141 million, and yet they still returned $253 million worth of capital back to shareholders through repurchases of common stock. So they are prioritizing returning value back to shareholders, even in a year where their operating cash flows were low and their free cash flow after subtracting capital expenditures was negative. And so that could be a good sign for shareholders, because if management is repurchasing shares of their common stock at the current share price, could be an indication that they think that the shares are currently undervalued, which means that they're going to increase into the future. And so right here we can see this is my discounted cash flow model for the intrinsic value per share analysis. And Yahoo Finance, from what I observed, is basically estimating that they think this company's going to grow at about 18% over the next 5 years compounded annually, and then about 9% for the next 5 years after that. That was my estimate, just cutting the first value in half. They have $581 million worth of free cash flow in 2021, and then about $2 billion worth of debt on their balance sheet after subtracting cash, and around 452 million shares outstanding, which puts their intrinsic value per share at around $24.95 per share, so around $25 per share. And that means that they're currently trading below intrinsic value per share at the current share price of $22 per share, trading at around $2 to $3 below intrinsic value. So if you want to buy at a 30% margin of safety or 50% margin of safety relative to intrinsic value per share, just to give you that space for error, you want to buy in at around $17 or $12 per share. But they are currently trading below intrinsic value per share, even though they're up about 24% over the last year, beating out to the rest of the market over the last year or so. And so on the right-hand side here, I compared them to some of their competitors, Sanmina, I believe that's pronounced, Arrow Electronics, and Benchmark Electronics. And in comparison to the rest of the competitors, their gross profit margin is the lowest at around 7%, and their net profit margin is actually the highest across all of the companies in this analysis. And then their return on assets is basically middle of the pack, underneath Sanmina and Arrow Electronics and above Benchmark Electronics. And I was a little curious to see if the other companies in this industry were also trading below intrinsic value per share, similar to Flex. But in doing a little bit of research about Sanmina, Arrow Electronics, and Benchmark, I found that all of these companies are actually trading above intrinsic value per share at the moment through a combination of either low projected growth rates, negative free cash flow in 2021, or negative growth rates in some case. And so Flex was the only company out of these four in their industry that had positive free cash flow in 2021 and also positive and strong growth rate projections into the future for the next decade or so. And that was mainly what differentiated them from their competitors in terms of pricing them below intrinsic value per share, whereas the rest of their competitors were overpriced from the looks of it. From a competitor analytical standpoint, just from looking at their financial ratios, looks like Flex is pretty competitive. They do have the highest net profit margin, which is one of the most important things because their bottom line revenue or bottom line profit is what they keep. So that's definitely a good sign. Although from a competitor analysis standpoint, it would be hard to differentiate them between the companies to figure out which one would be the strongest buy. But I could say that from an intrinsic value standpoint, after looking at all four of the companies, Flex looked like it was the only one trading below intrinsic value per share. And so based on that, coupled with the fact that they are trading below intrinsic value per share and they are beating the market over the last year or so, it seems like they could potentially present a good buying opportunity at the moment. But that's also just with the estimate that they're going to grow at near 20% every year for the next 5 years, which is possible, especially considering the fact that their market capitalization is pretty low at around 10 billion, so they do have a lot of room to grow. So it'll be interesting to see where this company goes from here. They are up about 20% over the last 3 months, so it's been a pretty decent run for Flex in the last quarter or so. Definitely going to be keeping my eye on this stock. Not sure what to think of it right now, but let me know in the comment section down below what you guys think about Flex and if you guys are looking to buy into shares of this company. And also let me know if there are any other companies in the market that you guys would like me to look into or that you guys are watching right now on your personal stock market watch lists. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.